Alright, today we're looking at Westamerica Bancorporation. They're based in California, ticker of WABC. If we look at their pricing, we can see that they've got about a $1.2 billion market cap. It's pretty average sized bank for publicly traded community banks. They've got a pretty low PE ratio, so 7.98 or 7.93. That's about a 12.6% earnings yield. So that's pretty high. It's priced pretty cheap, and that also gives it a pretty good dividend yield as well. So we can already see that based just on its earnings, the bank is priced pretty cheaply relative to the way that most banks are priced. Come over to the statistics, see the price to book is a little over 1.5, so that's a little bit higher than most banks. 1.6. Usually they're usually around 1 or so, and so or a little over. So relative to its book value, it's priced pretty high, but relative to its earnings, it's priced pretty cheaply. So once we dig in, we'll be able to see, maybe why that is. We can see, though, that it is a whole lot more profitable than some other banks in our database. The return on assets, we might see somewhere between 1 and 1.5, I believe. Return on equities, 10 to 12%, something like that. These guys are almost double that, so about double the profitability. Same on the margins. So they're doing something different than most banks that are making them a whole lot more profitable. And even then, the price of the stock is cheaper than than that of most banks for a higher amount of profitability. So just from this, I can tell maybe this might be a good bank to buy if there's not a whole lot of big risks. It's profitable, seems like a low price relative to that profitability. So let's start digging in to see if we can identify if it might be a good bank to buy. So taking a look at the balance sheet, the biggest thing I notice here is that they have a lot of securities, way more securities than most banks do. And really the securities are the dominant assets on the balance sheet compared to loans, which is the reverse of what most banks are. Most banks have a whole lot more loans than they do securities. So that's something very unique about this bank, and so we really need to look at it differently than the way that we would normally look at it, because a lot of our ratios and considerations are geared toward what does their loan portfolio look like. But in this case, the loans is a small percentage of the balance sheet, so we need to more hone into the securities because that's the more material part. Another thing to notice is that they have a lot more cash than most banks. It's almost 7% of their balance of their assets is cash. Most banks is somewhere between 4 and 6%. So they've got a little bit more cash and a little bit more securities. So it almost seems like the way that their balance sheet is structured is a little bit more liquid and allocated toward securities. So the liability side, the first thing I notice is that their non-interest bearing deposits is a really, really high percentage of their liabilities. Almost half of their liabilities are non-interest bearing. So that's amazing. That's probably mostly why we notice them being way more profitable than most banks. It's because they've got their funding sources have no cost. At least half of their funding sources have no cost, basically. And then they pretty much have almost no debt as well. $200 million on the BTFP. This is a little bit higher costing funding source, usually somewhere between 5 and 5.5%. But it's a very small percentage of the liabilities. So what we find is that most of their funding sources are either have no cost or are savings accounts and time deposits perhaps that are a cheap source of funding. So really the ability of this bank to make such a high profit, it seems, is probably due to allocation on the liability side of their balance sheet. But also, I'd be interested to see, and we'll dive into it in a little bit, how the asset side of their balance sheet affects the interest income, because securities typically have a lower yield than loans do. So does that hurt the interest income side by them being more allocated to securities? And I guess we'll find out once we dive into it. But as it is, we can see that they've done a really good job of acquiring cheap funding sources that they can purchase securities with. So, all right, so we can go down to the income statement and see how things look there. Yeah, as we saw, most of their balance sheet is securities, about 44% of the assets. So as we would expect, most of the income comes from securities interest. So about 55 million or so. And then they've got about 11 million comes from loans and some of it from interest-bearing cash. So if we were to look at the percentage of these compared to the asset, the loans are about 5.35% yield, which that's fairly average to most banks. The securities are about 4.62%, and that's way higher than most banks, at least currently. 4.62%. Most banks will be somewhere between 3.3% yield on their securities, but these guys are yielding 4.62%. So it'll be interesting to see the composition of their securities and why it is that they're able to earn a higher yield on them. So my thought of the securities hurting them by being allocated there because it's a lower yielding asset, I think is false, because perhaps they have a different allocation to a different type of security than what we normally see, which might be mortgage-backed securities, something like that. So this in total, the 68 million of interest income is about 4.56% of assets, and that's on the low end of the range of what we might see for most banks for interest income relative to the assets. So they are earning a little bit less yield on the assets than what we might see with most banks, but it's not an egregiously low amount. So so not too bad. I was kind of worried about the securities, the high allocation to securities might lower their interest income, and it did by a little bit, but not as bad as what I might have expected. So. And we'll learn more about what their securities are composed of soon. But and on the debt or the interest expense side, we can see a little more of how this works out. And this is a really, really low amount, $3 million of interest expense. It's a crazy low amount relative to the assets and to the revenues, and it ends up being 0.21%. So 0.21% of assets is interest expense. We would normally see somewhere between 1.5% to 2%, but these guys are paying 0.2% of their assets in interest expense. So that results in a $65 million or almost $68 million net interest income, and that's 4.07% of assets. We normally see around 3%, so these guys are earning a way higher net interest income than most banks, and as we saw, it's mostly because they are able to acquire really, really cheap funding sources, so that's awesome. they're really making a lot of money here. And if we go down to the non-interest income, non-interest expense side, we can see what else is going on that's separate from the yielding assets and liabilities. So 11 million of non-interest income. That's about 13% of revenues. So that's right in the range of the average bank. And then non-interest expense is 26 million. That's about 33%. And that's way less than what most banks are. So they not only are making a whole lot more money on the net interest income side, but they're also paying a whole lot less in expenses. So that really catapults them into making a lot of money on their income statement relative to most banks. So we can see at the end of the day, the net income is 36 million. So 36 million out of the total assets. That's about 2.29% return on assets. Most banks will see somewhere around 1% return on assets. So these guys are making double the money of most banks. And as far as the pricing of that earnings goes, that ends up being the 36 million ends up being 11.66% of the market cap. So that's almost a 12% earnings yield, which is above the range of what we might see for the pricing of most banks. Most banks be somewhere between 9 and 9 and 11ish earnings yield currently. These guys are making 11.7% earnings yield. So really good earnings yield for a really good profitable bank. And possibly, depending on the composition of these securities, it could be a whole lot less risk on the asset side of the balance sheet. But yeah. So the combination of lower funding sources and higher interest income on securities than what we normally would see, and in addition to lower non-interest expense, this bank is making a whole lot of money, and it's priced relatively cheaply to that earnings as well. So it'll be interesting to see how the other components come out with the bank, but as it is, it looks like it might be a really good, profitable and priced bank to buy. So coming down into the footnotes, the first thing we can look at is securities. So we were really interested to see the composition of these to figure out why it is that the interest income is so high. So right off the bat, by looking at this, we can see that they have a whole lot of corporate securities. That's pretty uncommon for most community banks. Most community banks will have mortgage-backed securities or collateralized loan obligations will be the majority of the allocation to securities, but these guys have got 1.9 million plus 700,000. So about 2.6 billion in corporate securities. And so that must be the reason why their interest rate or the yield on their securities is so much higher than other banks, because they're more allocated toward corporate securities, which perhaps earn a higher yield. Yeah, and this is really unusual. This percentage works out to about 55% of their securities are corporate. In the normal bank that we see, that percentage will be 2 to 6%. So these guys have a lower allocation to loans, but they've allocated a whole lot more to corporate securities, which are perhaps yielding a little bit more than what most securities are. Probably not as much as what the loans could yield, but we'll be able to see a little more of that once we get down into the MD&A and see the yields on each of the asset classes. But that's interesting to see. Also coming down here, we can see the term structure of their securities. We've got the mortgage-backed securities, collateralized loan obligations down here because they don't necessarily have a maturity, so to speak. But we do see here that most of the loans mature, or not loans, securities mature in 5 to 10 years. So that's pretty far out there, but maybe not as bad as what some banks might be. There are none above 10 years, so that's great. Most banks will see somewhere between 20 and 35% of their securities mature after 10 years. These guys have none. So from a interest rate risk perspective, this might not be too risky. Of course, as we mentioned at the beginning, we need to really hone in on the securities part as opposed to loans, because this is the larger part of their balance sheet. And most of the banks that we look at, we more hone into the loans because they're more allocated to loans. But this one, we're looking a little deeper into the securities. So the repricing timing of the securities would be really important to us for the interest rate risk. So we'll be able to see a little bit more of that in the MD&A as well, but it's interesting to see there. They've got a lot of unrealized losses, as do most banks, so that's not that unusual. You know, one of our biggest concerns having corporate securities would be that there's some credit risk in there, right? But as it is, I believe they've only allowed for $1,000 of a loss on their credit securities out of, or the corporate securities out of, $2.6 billion they've allowed for 1,000. So that seems pretty low. But we don't know the credit ratings for all of those. These are just the held to maturity. So most of them are, investment grade. And down in the MD&A, we'll be able to see a little bit more about, a little bit more detailed information about the securities, and we can kind of make an assessment of the credit quality of them there. But so here's the loans. As we mentioned, the loans aren't as important to us as they might be for many banks, because it's a really small percentage of their balance sheet is loans. But we can take a look here. So we got $845 million of loans, really small amount, and we've got a $15.9 million allowance on those. And that represents about 1.88%. That's a really high percentage. Most of the time we'll see 1.10, 1.26% for the allowance as a percentage of the loans. These guys have 1.88%, so they have a lot higher reserve than what most banks have, and perhaps they're being very conservative, which would be a good thing. Coming down to the credit risk profile, we see that they do have a lot of classified loans, so those ones that are substandard or worse, and it ends up being $21.6 million, which is 2.56% of the loans. So 2.56% of the loans are have issues, and they might not be able to collect the full amount of the loan. So that's not good. That's really high compared to most banks. Most banks would be 1 to 1.5% will be classified. These guys have 2.56%. So we can already tell that there's pretty poor credit quality in their loan portfolio, and they've allowed for more than what most banks allow for, but it's not the 22 million that is classified. I'm normally looking to see, have they reserved at least the classified amount, which is probably a bit over conservative anyway, but it tends to be what the average bank has reserved, the amount that they've reserved for. So, and we can also see, there's some past due loans here, so 5.6, 1.2, 0.5 plus 1. That gets 8.4 million of the loans are past due, which is about 1%, and that's higher than the range that most banks are in as well. So we can already tell that they've got a lot of past due loans. A lot of them they've classified relative to the loan balance. But, as we stated before, the loans aren't necessarily as important to us as what the securities were. So, and, even coming down to collateral dependent, about $12 million of collateral dependent loans as well. That's almost 1.5% of the loans. That's about double, more than double of what we might see. So, that leads me to believe that all this together, pretty poor credit quality of the loans. But the loans are a pretty small percentage of the balance sheet, so maybe that's not that big of a deal. So if we think about that, the difference between what they've reserved for, which is about 16 million, compared to what the classified loans are, which is about 21.5 million, that equals about 21.5 minus 16. So that means they're potentially under accrued by 5.5 million. So how does that affect our profitability? They made 36 million this quarter. So if I multiply that by 4, it's 144 million. So minus 5.5 million for being under accrued. That's 139 million of net income adjusted for what they might be under accrued. So if we compare that to the market cap of about 1250, that's still over 11%, which is a really good earnings yield. So I feel like, they should reserve a bit more for having a little bit riskier credit risk in their loans, but in the grand scheme of things on the whole balance sheet, it doesn't really affect it by a whole lot. So the price for the company is still pretty cheap, even if they were to lose what they potentially under accrued for. So that's really that makes me feel good about it. When in normal cases where a bank is more allocated toward loans, I might be a little bit more pessimistic toward it. But in this case, I feel like that the credit risk is not, and related to the loans and potential losses is not as material. So carrying on, we can see most of the debt is, we got 50 million of repurchase agreements. So those usually reprice daily. They also have 200 million of the bank term funding program, which that program was initiated back in 2023 and supposed to end, I think, March the 11th. Doesn't say it here, but the last time you could have gotten a loan for that was March the 11th. So these are all less than 1 year. They're 1 year borrowings. It's the way that the program was set up. So very small amount of debt they have on the balance sheet that reprices really quickly. So by next year this will be gone, at least the funding for this particular program. And so coming down to the fair value measurements, we can see the difference of the fair value of the assets versus what it's carried at on the balance sheet. Currently held to maturity securities is fair values are about, about 30 million, about 40 million less than what's carried on the balance sheet. Loans is about 10 million less. So all in all, this decrease in fair value is only about 6% of equity. So these guys are really well capitalized, and so changes in the fair values of these haven't affected the balance sheet that much. Also, most of them are available for sale, so they're at fair value on the balance sheet anyway. So, I know that we saw that the price to book is on on the Yahoo Finance page was about 1.5, 1.6, something like that. But we have to take that in regard that it's not an apples to apples comparison, the book values, because these guys have most of the assets on their balance sheet at fair value. The available for sale securities are at fair value, and they represent a much larger percentage of the balance sheet than what most banks do. So those available for sale securities have been decreased to fair value on the balance sheet, whereas most banks will have their loans as a larger percentage that are at the amortized cost, and so they haven't been decreased by fair value. So just by looking at the price to book ratio, you might be deceived into thinking that the price is really expensive relative to the net assets, but that's not the case, because this bank has most everything is already down to fair value. So whereas other banks, their assets are a little bit elevated because they haven't been reduced to fair value. So that's what's important, to really digging into the details of this, because that way we can compare banks apples to apples. And so actually, if by converting everything to a fair value, even the liability side of things, it equals about 2 times. So price to book on a fair value basis and a tangible basis, so excluding goodwill and intangibles, is about 2 times. You'd be paying 2 times the fair value of its net assets. And that's right in the middle of the pricing for most banks currently. Most banks somewhere between 1.5 to 2.5 price to net fair value of assets. And so this price, for its net assets is about average. If we were to look at the capital robustness of the bank as well, if we looked at the net assets at fair value compared to the assets at fair value, they have a lot of equity compared to the assets. So it's it's about 10%. The fair value of its equity relative to its assets is about 10%. Most banks will be around 5%. So this bank has about double the capital than most banks. So it's a really well capitalized bank. And coming down into the MD&A, they've summarized a lot of the stuff that we've discussed so far. So it's interesting to see this. The return on assets, 2.24%. As we discussed, that's about double of what we might see for most banks. Return on common equity, that's a lot as well. We might see somewhere between 10 and 12%. These guys are at 15%. Net interest margin, 4.3%. Most banks is around 3%, so these guys are making really good money on the net interest, as we saw, as a result of having some cheaper funding sources. Efficiency ratio, 34%. That's really, really low. It's actually about half of what most banks will have, and so we want the lower the better for the efficiency ratio, because it's expenses divided by the revenue. So these guys are making a lot of money compared to the non-interest expense that they have. So all these ratios are just like off the charts good for a bank. Even their capital ratios here, which we've talked about. So, tangible equity to tangible assets, almost 11%, and that's way more than what the typical bank will have. And risk-based capital as well, which is the regulatory capital, is 20%. That's basically almost double of what most banks might see. So, from this, we can see, not only is the bank extremely profitable, they're also extremely well capitalized. So, it creates a really good value. So here we can dig into the net interest margin. As we were talking about, we were interested to see, like, well, the securities seem to earn more than what the normal bank is, and so we can see that they're earning about 4.32% yield, mostly because the corporate securities perhaps earn a higher yield than what we might normally see in a bank, which would be the mortgage-backed securities. And so, so most banks, the securities earn between 2.5% and 3%, but these guys are earning 4.32% of their yield. So, which actually it looks like is, it's a little bit less than what their loans are yielding, but not so detrimentally low that it's reducing their interest income. So that's why we ended up with interest income a little bit on the lower end of what we might see for a typical bank, but not so low that it's really hurting their profitability. And we talked about earlier, they've done a really good job of finding really, really low cost funding sources. Not only do they have $2.5 billion of non-interest bearing deposits, but even their savings accounts and time deposits are really, really low priced. 0.3% is a really, really low yield. Even 0.3% on a savings account right now is really, really low. We would normally see somewhere between 1.5% and 2%, but these guys are able to pay only 0.3% for even their time deposits. So it's really unheard of, and I suppose there could be a risk there that eventually the customers move on to earn higher interest rates, but perhaps they don't have much migration. And then also they got the bank term funding program at 5.4%, which is a higher cost funding source, but that should they should pay that off soon, and that'll be gone. And so then the interest expense side will be yielding 0.3%. So that's amazingly low yield to have to pay. And so then they have to, or the interest margin is about 4.3%. So that's incredibly high. As we said, you normally see around 3%. So that's just incredible profitability out of this bank. And as we discussed earlier, we wanted to look a little bit deeper into the securities portfolio. Here it is. So we can see that 55% of the securities are corporate securities. I believe they've only allowed for about $1,000 of a reserve for credit losses. So we really want to see, like, does that make sense that only 1,000 out of 2.6 billion might have losses? And so coming down here, we can see the credit ratings. They're all investment grade, so most of them fall into the A- bucket, so triple B. So these are all within investment grade. I could see some of the Bs having some losses, and perhaps they should have accrued for those, but they haven't. But it mostly falls into the financials, so perhaps lending to other banks. But as it is, them being investment grade, maybe having a large allowance against them really isn't necessary. I've seen other banks have a larger allowance on their corporate securities, but these are all investment grade and perhaps well secured. And the collateralized loan obligations are senior tranches, AAA and AA, so those are all investment grade as well. So I feel a little more comfortable about the securities credit risk. Now, it could come about later on that greater reserve should be should be made, but as it is now, I feel pretty comfortable with the credit risk of the securities portfolio, as well as the loan portfolio, where we're talking about it doesn't end up being that large of of a risk, considering that less loans are on the balance sheet than most banks. As far as the interest rate risk goes, we have here their schedule of what would happen if interest rates went up 1%, 2%, down 1, down 2. So we can see that if interest rates go up, these guys make more interest income, and if they go down, they make less interest income. So I like that scenario. I prefer the banks to be a little more asset sensitive, because a bank naturally, the liability side reprices faster than the asset side. So I think any kind of sway that a bank can make toward an asset liability or an asset sensitivity makes it a little less risky from an interest rate side from getting squeezed. But as we've seen, the majority of their liability side is, well, not the majority, but actually almost the majority, about 44%, right, of their liability side is non-interest bearing. So there's not as much risk there for liabilities repricing, because they're non-interest bearing. So it's a little bit easier for this bank, I think, to be asset sensitive because of that. As far as the liquidity goes, we were talking about earlier how they've got 400 and something million of cash, which is a lot more than what most banks have. Also the securities are a little bit more liquid than loans, so they're definitely a little more liquid from that standpoint. And so if you were to add up the bank's on balance sheet liquidity, which would be the cash plus unencumbered securities, it ends up being a little over $3 billion, which is 60% of their deposits. Most banks, that is somewhere between 12 and 17%. So these guys have 60% of their deposits in fairly liquid assets, and that's just far and above what most banks are as far as liquidity. So I feel like they could weather any storm, but they also have the ability to borrow from wholesale sources, with not only the securities that they have pledged for collateral, but also securities that they haven't pledged for collateral. So having that higher percentage of securities on their balance sheet really gives them not only the on-balance sheet liquidity, but also potential off-balance sheet liquidity where they could pledge and borrow more. So these guys are in a really liquid position, and as we discussed elsewhere, they have a high capital position as well, and we can see that in the regulatory capital ratios, which are all about 20%, leverage ratios 13%. So these are all almost double of what a normal bank might be, and far and above what they're required for capital adequacy purposes. So really well capitalized bank, really liquid bank. And so to recap everything, from a profitability standpoint, the bank is making a ton of money compared to most banks. I mean, they do really well due to their low cost of funding. The interest income side might make a little bit less because they're allocated more towards securities than loans, but having the lower cost funding sources really boosts their profitability. They also have a lot less non-interest expense, which really boosts their efficiency ratio. So really profitable bank. As far as the risks go, the interest rate risk is really low because they have most of their liability side is non-interest bearing. not most, but 44% of it is. So there's not as much risk from repricing on the liability side. So pretty asset sensitive balance sheet, which I really like. As interest rates go up, they make more money. Really good interest rate risk. From a credit risk, we do have some a little bit of quality issues in the loan portfolio, but since the loan balance represents a really small percentage of the balance sheet, as we calculated, it doesn't have that material effect on the income potentially. So, as far as the securities go, they're all in investment grade securities. There could be, down the road a potential for corporate securities to have issues, but as it is now, they're all rated investment grade credit ratings, so I don't see any major risk there. So I would say that the credit quality of the balance sheet is good. And then also, what we just talked about from a liquidity and capital standpoint, they've just got really, really well capitalized bank, really, really liquid assets. So they're really in a good place. And, as far as the pricing goes, we saw that they've got, above 11% earnings yield, which is really, really good. They also, if you were looking at it from the perspective of just buying the net assets, that's at a really fair price as well. So I think this is a good buy. You're making, it's a bank that's making a lot of money compared to the price. The risks aren't so much that we would want to be compensated with a lower price. So I think it's a really good bank for the price that it's sitting at in the market. So yeah. So thanks for watching. Let me know in the comments what you think, if there's anything I missed, or if there's some if you agree or disagree, or kind of what your thoughts are. I'd love to hear what you think. Thank you for listening.